What is up, everybody? Jay Costa here. Welcome back to the channel. Today I'm going to give you some reasons why I think that the recently declining stock market, as well as a looming recession, may possibly affect and maybe even crash the housing market. But first, before I get started, you guys, I want to thank you so much for tuning in and watching the channel. My name is Jay Costa. I'm a real estate agent and investor here in Northern New Jersey. If you get any value out of this video at all, please hit that like button down below, comment, and subscribe down below as well. I really love the comments. I want to see what you guys have to say. Now, on to the video. If you haven't been paying attention, well, good for you, but the stock market recently has really been struggling. The Nasdaq is already well into bear market territory, down 26% from its highs, and the S&P 500 is not far behind. The general concern from investors is that inflation is not going to be able to be held under control without causing a recession. So if the US economy goes into recession, what does that mean for the housing market? Will it crash, or is real estate a safe haven in inflationary times like some people say? Now, no one truly knows what's going to happen next, but with mortgage rates at almost 6%, homebuyer demand has slowed down significantly, with home showings down year over year and mortgage applications down drastically. As of now, home prices have stayed at all-time high levels, but what happens if that homebuyer demand decreases further and the US economy goes into a recession? Now, right now you have every real estate agent out there saying the same exact thing, citing supply and demand, supply and demand. And I don't know about you, when everyone starts parroting the same thing over and over, I tend to get a little wary and skeptical. They cite the fact that home prices simply cannot come down because there's simply too much demand and too little supply. And that we're so far off on that delta, even if there were to be a shift the other way, it would take a long time to turn into a seller's market. I disagree. I think it could happen way quicker than you think. While it is true for sure that inventory is still down at all-time low levels, we are down on inventory significantly compared to this time last year. The biggest reason for that is that a lot of homeowners are simply stuck, locked into their house. I know so many homeowners who would want to move to either get a bigger house or to downsize, but they simply cannot find a suitable place to move into with inventory so low. In addition, most homeowners either bought or refinanced within the last few years, so they're paying a very low mortgage rate, like 2.5% or 3%. And with mortgage rates at like 6% now, why would anyone go buy a home at 6% and replace a 3% mortgage? So most homeowners are simply deciding to stay put, and it just turns into a vicious cycle. So with supply still staying at all-time low levels, home prices are just going to continue to trend upwards, right? Well, not necessarily. You see, the last 2 years have been what the Federal Reserve of Dallas has called irrational exuberance in the housing market, and I would say most of our economy. The stock market, the housing market, the used car market, crypto, everything has gone almost parabolic while the country was widely shut down and the Fed was printing money like a drunken sailor. During these times of irrational exuberance, it's very easy to be convinced that everything it just continues to go up. But since the stock markets have come down significantly from their all-time highs, a lot of investors have been hit with a reality check, and I think that reality check may be coming soon to the housing market. With the stock market going down 6 weeks in a row, what is that going to do to consumer confidence levels? Are consumers going to be less likely to go buy that second home, go lease that new car, go overextend themselves just to get into a property? I think so. In addition, most down payment money from home buyers is coming from the stock market. With the stock market coming down, is that going to affect timing of a lot of potential home buyers? I think so. This all negatively affects consumer confidence. And when consumer confidence goes down, what is that going to do to businesses and employers? Are they going to be less likely to invest and hire? Are they still as bullish on the US economy? You see, you could cite supply and demand all you want. And yes, the basis of the housing market is just like any market where supply and demand sets the price. But all these real estate agents are just assuming that the demand will always be there. Now, you could definitely point to the generational and demographic shift in our country, with a lot of millennial buyers still just getting into the housing market and Gen Z right behind them. And the fact that we simply have not kept up with building new homes. But what if we go into a recession and a lot of these millennial home buyers get laid off from their work from home job? Also, as inflation and gas prices tick higher and higher, that will take away demand for non-essential expenditures. This may hurt consumer spending and cause more employers and businesses to start laying people off and cutting back. If some of these people that get laid off are homeowners, they may be forced to sell their house in order to avoid a foreclosure, especially if they bought recently at all-time high levels. And even worse, if they're paying a 5% or 6% mortgage rate. This could drastically shift the housing market from a strong seller's market to a more balanced or even a buyer's market very, very quickly. By now, you could see how all this can be correlated and how quickly things can change. Yes, right now we still have a strong seller's market with low inventory, but it wouldn't take much to throw everything off and send a lot of homeowners into despair, especially if they stretch themselves too thin. By the way, this doesn't only affect homeowners, it affects investors as well, maybe even more so. I have heard a ton of blame being pointed at investors, both big and small, in regards to the reasoning as to why the housing market got out of hand. I would personally disagree with this. To me, it was government policy putting interest rates at 0, which caused investors to go search for opportunity that won't be there forever. That is their job. But I have seen so many properties in my area here in northern New Jersey sell to investors, especially smaller ones. They way overpay for the property. It's not cash flowing at all because they are banking on future appreciation. Well, once that appreciation looks like it's getting to an inflection point and starts either stabilizing or even going down, these investors that were banking on future appreciation can turn around and sell that house very, very quickly. It is much easier for an investor to sell the property because they don't live in the property and they don't need to find something to replace it with. They could sell it with tenants in place even and move on. So what can you do if you're a buyer in this market? Well, you first need to keep an eye on 3 very key data points. Number 1 is obviously inventory levels. Number 2, keep track of the stock market. See what's happening and see how much further it goes down from here if at all. And number 3, maybe most importantly, is the unemployment number. Unemployment will most likely take a tick up. That's kind of the point of raising rates, is to slow down the economy and slow down hiring. But if it gets to a level that is a little discomforting, we need to reassess the housing market. These 3 data points are very important to understand and to follow to see any potential upcoming shift in the housing market. And also, as always, make sure you're putting as much of a down payment as you can in order to protect your equity just in case there is a downturn. Also, make sure you don't overextend yourself on the monthly payment. This will be much more difficult with these higher interest rates, but it's something that just has to be done. Because the buyers and investors that were too risky and spread themselves too thin, those are the ones that would get hurt in a downturn in the housing market. As long as you're conservative with your numbers and have a long time horizon, you will be okay. That is it for today, guys. Thank you so much for watching. Let me know in the comment section down below where you think the housing market is going from here. Let me know what you think about my thoughts in regards to the stock market potentially affecting the housing market and the economy as a whole. Do you agree or do you disagree? Let me know in the comment section down below, and until next time.